Financial audit risk exists at two levels. One is the financial statement level and the other is the account balance or class of transaction level. The financial statement level risk, right, is faced by the external auditor while auditing the financial statements of the client. Okay, the financial statement level risk. What is the risk? That the auditor may not qualify his report on financial statements that are materially misstated. He may not know. That is the risk of an external auditor at the financial statement level. What are we looking at, students? The financial audit risk. Now, the account balance, a particular balance, a class of transaction, that level, this is financial statement, it's a higher level, right? This is faced by the internal auditor while considering the financial statement assertions. Many management makes several assertions about the balance of inventory, about the balance of debtors, like I said before, about the fixed assets, about the charge of depreciation, etc. Now, what is the internal auditor's risk? That some of these financial statement assertions, these statements which are made by the management are not true. They are not really true. There is a misstatement there. Mind you, internal audit is actually a part of the management team. Risk is that the account balance or transaction assertions by the management contain misstatements and they are not detected by the auditor. So these are the two kinds of risk that is possible. And faced by the external auditor, faced by the internal auditor. Of course, we are considering the audit risk of the internal auditor. Now, the kinds of internal audit risk may be inherent risk, may be control risk, and may be detection risk. Let's just understand this first. What is inherent risk? The risk which is there, which is just there in the transaction or business process. Control risk is the risk which is there due to poor controls, internal controls. And detection risk is the risk that the auditor will not detect the misstatement. Okay. Now, inherent risk is the possibility, of material misstatements in financial statements from something other than failure of controls. We are not talking of controls. This risk is inherent in the particular system. It is just there. It just exists. Maybe because of the complexity of the transactions. Maybe it is valuation of derivative instruments. Maybe during account close times, people have to work under so much pressure, so many different kinds of transactions, errors may come. So it is the process. It is that there is a chance of error because of the particular process. And the risk that this kind of error will come, this kind of material misstatement will be there, is just that risk is simply there. It is not really the fault of the management or the auditor. It is just there in that particular process, exists in that particular process. Followed, control risk is the risk of misstatement because risk of misstatement and which goes undetected, of course, or prevented by the internal control mechanism. They have a control mechanism, but still it is not detected. That is the control risk. You have to strengthen the internal controls. Of course, I repeat again and again, however strong it is, fraud may still occur. That is a different thing. But when, because of weak controls, there could be a risk that there is a certain misstatement and we don't detect. That is called the control risk. Detection risk is, of course, audit procedures. So we've done audit, we were not able to detect this material error or fraud. Maybe we had not taken, as auditors, we had not taken enough samples. Maybe we had misread, we did not misjudge, we did not understand the extent of it. We had read wrongly the strength of the internal controls. Followed? So this detection risk is the problem of the auditor. Control risk is the problem of the management. Inherent risk just exists as it is. Neither the management nor the auditor has any control. Clear? It just exists. It's an inherent risk. Now, what is audit risk? residual risk, audit risk is a combination of these three risks. Is the risks that an auditor may issue an unqualified report due to the auditor's failure to detect material misstatement either due to error or fraud. So there is an error, there is a fraud, but the auditor was not able to detect and therefore did not report. That is the audit risk. It's called residual risk and is computed as the inherent risk multiplied by the control risk multiplied by the detection risk. Clear, students? That is a summation of the audit risk. The inherent risk is inherent in the system, right? The control risk depends on the strength of the internal controls developed by the management, right? Auditor cannot influence the inherent risk or the control risk. Control risk can be influenced by the management, has control. Inherent risk is there in the process. So what can the auditor do? The auditor can only control the detection risk. He can minimize the detection risk. The level of this detection risk will determine the nature, extent and timing of the audit procedures. So if he feels the detection risk is very high, he will increase his audit procedures, increase the number of samples, increase the sampling size, etc., etc., etc. Are you following, students? The total audit risk is a combination of inherent, control and detection risk. Now, inherent risk is just there in the system, nothing can be done. The auditor also does not have control over the control risk. So, based on the control risk, the auditor will decide what should be his detection risk. And based on the detection risk, he will determine the timing of his audit, extent of his audit, the size of his samples, etc. Auditor will first ascertain the level of acceptable audit risk. How much? What should be the audit risk first? Clear? Then he will assess the inherent risk and the control risk. Followed, what is the audit risk required? Once he arrives at that, he tries to make an assessment of the inherent risk which is there. Then he studies the control risk. So then he knows now what can be his detection risk. Higher the control risk. What do you mean by high control risk? One second, students. This you understand, the strength of internal controls and therefore the control risk will determine the detection risk. Now, higher the control risk, that means greater the chance of errors and misstatements. Correct? Then lower must be the detection risk. Then I cannot afford to have a high detection risk. Do you understand? If your control risk is very high, then I have to do something and minimize my detection risk. Followed, so more intensive audit procedures will be there so that my detection risk is minimized. If the control risk is low, that means there are very strong controls. The risk of lack of controls, the risk of fraud error occurring because of lack of controls is very low. Then I can afford to take a higher detection risk and can reduce the intensity of my audit procedures. Are you following? So audit risk is a function of all three. Inherent risk is anyway there. I assess what it is. Control risk is controlled by the management. Auditor doesn't have any control. He assesses what it is. He knows the acceptable degree of audit risk. Now he therefore arrives at what his detection risk should be. Higher the control risk, lower must be the detection risk. See, inversely proportional, correct? They are related in an inverse manner, not directly related. Lower the control risk, higher can be the detection risk. I may not have very high, very, very intense audit procedures. Findings and recommendations. Auditor's report identifies findings which are what? Conditions or issues to be addressed. Findings are what? They are the performance or the actions which are measured against the firm's policy. So, firm has a policy. What is it actually? When I compare, I arrive at a finding that they are in compliance, that the procedures are being followed. not followed, etc. So findings are nothing but the performance or the actual actions measured against the firm's policies, procedures, standards, or external regulations, and against risks such as inadequate safeguarding of company assets. So finding is I find out whether they are in compliance, whether internal controls are adequate, whether there is enough risk management, whether the company assets are safeguarded or not. That is my finding. This may be positive or negative, and they must be disclosed in a concise manner in a summary sheet, and then wherever there is an adverse finding, it must be discussed in detail. Mind you, all findings must be, definitely adverse findings must be properly evidenced. Evidence, absolutely important. Adverse findings are also called exceptions, and they should be supported by evidence. Followed. Auditor once he has identified the internal breakdown, the risk involved, he will make recommendations, suggestions for prevention, suggestions for correction, suggestions for the deficiencies, for correction of the gaps. These are identified. He may make recommendations. I repeat again and again. How exactly details of strategy, etc., will be left to the management. It is not the auditor's responsibility. Recommendations should be achievable in a reasonable manner. The types of recommendation: one is that you make no changes when the organization is in compliance with regulations, when the assets are adequately safeguarded, when there is sufficient control, internal control is strong, then there may be no changes. That's one type of recommendation. Next, another one is where there is weak control, where there are areas of risk, where there is poor performance, you modify, make a recommendation to modify the internal control policies and procedures. Then sometimes there is no solution as such except to take an insurance to safeguard. Instead of changing a policy and procedure, we take an insurance for the liability. Because sometimes despite controls, the loss may occur, the liability may arise. Therefore, taking an insurance at least guards us from a financial loss. And sometimes we may adjust the required rate of return to match the associated risk. So we need a much higher, if the risk is more, we need a higher rate of return. Right? These are the 4 kinds of recommendations that an auditor may follow. So an activity has greater potential risk than justified by the ROR, the rate of return.